Hi, I'm Jimmy. In this video, we're looking at interest rates and how the Federal Reserve is essentially kind of able to control the stock market or the direction of the stock market and where the stock market could end up now that interest rates are essentially at 0%. Plus, how will this affect our individual portfolios and what can we do to help safeguard ourselves against what the Federal Reserve could do? Okay, so let's start with interest rates in general. So this is a chart of the 10-year Treasury going back to 10 years or so. And just so we can see how similarly it moves to other interest rates, let's add the AAA Corporate Bond Index. This is the Moody's AAA Corporate Bond Index. And we may notice that these two interest rates move in a very similar direction. They move very similar to each other. Now, just so we're on the same page, the AAA Corporate Bond Index has companies that have the best. AAA credit is the best credit rating you can have. So these are the best companies that have the most trustworthy cash flow that a company like Moody's, which is a rating agency, they say that they're the biggest and the best companies. And just for good measure, let's add the average yield of BAA companies. So a slightly lower credit rating company. And once again, we can see that these tend to move very similar to each other. Sure, the lower the credit rating, the higher the interest rate, but overall the direction tends to be about the same. Now, there are a couple points of time on this chart that I think are worth recognizing. So, this time period here, well, during this time period, the Federal Reserve had recently started increasing interest rates. And then they paused increasing interest rates, and that alone triggered a little bit of fear from an interest rate perspective. And we could see that these interest rates began to drop. And then once 2020 began, the Federal Reserve aggressively started dropping interest rates right down to where they are today, which is practically 0%. And the overall interest rates that every level of company paid essentially dropped. And this is the way interest rates are supposed to move. They're supposed to move similar to each other. Now, if we were to overlay the target rate from the federal funds overnight interest rate, that's what the Federal Reserve sets. Well, the target rate is set to 0.25%. It's actually between 0 and 0.25%. But we can see how the overall trend of other interest rates move because of what the Federal Reserve is doing. Okay, so we know that bonds are affected by the Federal Reserve. That's obvious. But how does this impact the stock market or stocks in general? And first, we're going to look at it from a company perspective, and then we'll look at it from an investor perspective. And both are quite logical if we think it through. Let's imagine that we're looking at a company that has a fairly good credit rating, not AAA, but still a solid company. Well, back in 2013, they would have borrowed money. They had to issue bonds. They were going to borrow money at about 5.5%. Today, that same company is borrowing the same type of money in the low 3% range. So, all else being equal, that company is going to have a lower cost of debt. That will also imply that they will have lower interest expenses. Lower interest expenses is a more profitable company. And for that reason alone, well, that stock should be trading at a higher price. But that's only one small part of it. Now, the real reason the Fed is able to control the stock market is the same reason that Warren Buffett said this a couple years ago.
So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances. Because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now. And that's why they sell for very fancy prices.
So basically, what Warren Buffett is saying in that clip is that the higher the government bonds are, the higher the yield is on government bonds, well, the more a company needs to return in order for us to look at it as a valuable investment. Because if a company is going to return 15%, using his example, and the 10-year Treasury back in the 1980s was 15%, well, people will gravitate towards the safest investment. So if somebody needs 15% and the US government will pay them 15%, why would you go there when they're virtually guaranteeing it? Versus a company where there is inherently more risk. So the company has to have a greater return which means essentially we have to buy it at a lower price. And to illustrate how much these interest rates actually swing things from an investor's perspective, well, this is a discounted free cash flow calculation for a company. Obviously, the numbers aren't real. I just made these numbers up, but the concept remains the same. So all this calculation is essentially doing is it's taking our estimates for free cash flow, growing them out in perpetuity, so forever, and then discounting all those numbers back to today. We're discounting them back by our required rate of return. That's what this number is. Now, this idea isn't something that I came up with. Many of the most legendary value investors, guys like Warren Buffett, or even his teacher, Ben Graham, or guys like Ray Dalio, all adhere to this type of mathematics behind coming up with a fair value. To verify that, this is a clip of Warren Buffett where he walks through the very same concept.
You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons. And it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying. And you're buying the discounted value.
So using Buffett's language, well, we take these cash flow projections, he called them equity coupons, and that's what we estimate when we're trying to come up with whether or not we should invest in a stock. He called them equity coupons because in that video, the entirety of the video, he was comparing the concept of investing in stocks. He called it an equity coupon versus in getting the coupons from a bond. So with bonds, you get a fixed coupon rate. You know exactly how much you're going to get every 6 months or every year, whatever it is. With stocks, with equities, we have to estimate it. So we take those and we discount those back to today to see what they should be worth. That's what he said at the end of that clip. So in this calculation, I used a required rate of return of 7.5%. Now, I've been asked a few times, why are you using 7.5% as a required rate of return? And basically, when we switch back to our chart where we had looked at different levels of interest rates, well, I used to use 8.5% in some of my earlier videos. But then the Federal Reserve dropped interest rates. They dropped them by about 1%. So when the AAA corporate bond rate was in the 2.5% range, well, I had been using a 5% premium on top of that. That's where I came up with the 7.5%, 5% plus 2.5%. Before that, I was using 8.5% because it was about 3.5% plus the 5%. That's where those numbers came from. And this actually goes back to the concept that Buffett mentioned in the first clip that we looked at. If interest rates went up, well, it wouldn't make a lot of sense for us to keep these same expectations or the same required return from our investments. We would need some premium on what the bond rates ultimately are. So that's how I got to the 7.5% rate. But now, what if interest rates went up 1% tomorrow and they were expected to stay there? Well, it would only be logical for us to increase our expectations by, let's say, 1%. Let's say we upped it from 7.5% to 8.5%. Well, shifting to a higher required rate of return lowers the present value of the future projected cash flow numbers. This lowers the total company value, which in turn should lower the fair value of the stock. The stock will now be worth about $213 per share compared to the $256 we got when we were expecting a 7.5% return. Now, if we logic this out, hopefully this makes sense. If we want a higher return, we should pay a lower price. So if we want to return 8.5%, we should pay a lower price. Okay, now just to illustrate how this could impact things, what if it wasn't 8.5%? What if it was, let's say, 10%? Well, without adjusting any of the other numbers, let's say 10%, just so we're on the same page, the fair value comes out to be about $170 per share. So this means that when we shift the required rate of return from 7.5% to 10%, well, the fair value goes from $256 per share down to $170 per share. So a 2.5% swing in our required rate of return on an annual basis has a huge impact on the fair value of the stock today. Now, I picked the required rate of return using the corporate bonds. Like I said before, I had added 5% to corporate bond rates, and that's a logical way of doing it. But what if we wanted a more traditional method? A more traditional method would be to use something like a weighted average cost of capital or the capital asset pricing model. Well, in both of those, the risk-free rate, which is generally something like the 10-year treasury rate. Generally, the 10-year treasury is in those formulas. So a higher 10-year treasury, you're going to end up in the very same place. You're going to end up with a higher required rate of return. And stocks, by their nature, should be lower. And this brings us full circle back to the Federal Reserve. So we already saw that interest rates tend to move together. So if interest rates drop like they have over the past few years, well, our required rate of return should also drop. And then the fair value of the stock market should be higher. So it's very logical that the stock market continues to break all-time highs. Now, with interest rates so low today, well, what if they were to increase interest rates? Well, we know that should lower the value of the overall stock market. Now, I do think the Federal Reserve is going to be forced to increase interest rates, at least some, over the next couple of years. And when they do, that will surely slow the growth of the stock market. It is very likely that causes at least some pullback in the stock market. Now, if they have to increase interest rates at all rapidly by something like inflation, well, that could be a bad thing for the stock market as well. Now, I bring this out because I think that the best way to combat this effect of the potential of rising interest rates is that I think we need to avoid overpaying for stocks. I think we need to add a wider margin of safety for the stocks that we're considering. Now, I actually did a video called When to Buy a Stock, where I talk about adding a margin of safety to our fair value calculations that could help combat some of the effect of rising interest rates. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.